This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Adamus Principle. First of all, big apologies. I'm not trying to look mysterious, and I don't look ill. I'm not ill. It's just the colour of my face is a bit dark. So try not to laugh too much. Just take the content, not the style of the webinar. Thancfully, Beat, you look absolutely amazing. You look glowing. Have you just had one of your? Have you just had your weekly facial, or is that just your natural glow?
Oh, that's my natural glow.
Brilliant, brilliant.
To be honest,
That's
it's the first time we do that when it's still bright outside. So it must be that. Must be the sunlight.
It's, yeah, I know. It feels like I'm in a tanning shop.
Yeah.
So we've got a punchy one today. First of all, apologies, we didn't do it on Sunday. That was my fault. I had something I couldn't avoid. But here we go. It's Monday and it's 4:20 London time. Just really quickly, I want to talk about the US macro picture, just a bit of an update. I'm very privileged to get some great reports from some tier one macro agencies. Obviously, I'm not going to tell you everything they've said to me, but it's certainly a cause for pause. I feel, and certainly you said this some months ago, I think when we hit in the highs around October, everything was jolly, everything was pristine. And I think at the time, the City Surprise Index wasn't making new surprises. And there was a kind of thing, well, yeah, we're treading water, everything's priced in. I know you mentioned that on one of the shows, and you've certainly said it to me, Beat. I just feel there are some things going on in the US that could cause downside, could cause a sharp slowdown. And I just want to take my thoughts through really quickly. Housing, we've always said, is a problem. That's huge. I mean, it is absolutely huge. And it's not just in the US. Australia is a massive problem as well. China, they've got slowdowns through deleveraging problems themselves. Especially on the soft data. Look, the recent PMI was sub 50, says it all really. They themselves will come to a bit of that later, but on the US side, oil's, we've got a bit of a bounce obviously, but it's still way off its highs. Shale hurting, equities tanking, ISM's not really doing much above 50, so it's looking quite tired. CPI not tanking, but not going north. We're hovering around 2%. I know the core's around 2%, and I think that the headline's not too much more than that. The only thing is wages are firm, materially firm and accelerating. So that could put price pressure, could put pressure on CPI. It's just something to watch. The other things globally, China's creaking, as you know. We could be at the start of a very sharp slowdown. So I'm talking a recession. The OIS curve, I know, I'm quite into my rates sometimes, and that's fine. Okay, so one hike's priced in, maybe not, maybe it is. But the interesting thing is the rate cut is creeping in, and that's not going away. I know there's a bit of noise. I know the Fed's data dependent. I know patience is a word that's been used a lot from J Powell. However, the curve is the curve, and Eurodollar futures, along with the OIS curve, are pricing in a cut towards the end of this year. And there is a 37% chance of a 25 basis cut in January 2020. I know it's a bit far out, but all of this collectively, along with, look, 10-year yields finally broke 2.6. I think the recent lows were 2.55. But look at the monster levels we've gone through, like, a hot knife through butter. 3.25 capped, then 3, not a bad level itself. 2.8, pretty nice. 2.6 gone. So we're hovering. If we stay below 2.8, that's something. Bond bulls are having a right laugh. So, that's my kind of take. Just all of that stuff together collectively. I know we've got a shutdown. We've got a bit of a delay on the data, but 1 month is not going to change my view. If it steps into 2 or more months, then that's going to be different. What do you reckon, Pete, on all of that?
To be honest, I mean, I paid a lot of attention to the Fed speakers, and one thing, if you remember what we said at the back end of last year, we already said by natural change of voting members in 2019, we already knew we're going to have a more dovish Fed in 2019, and that is even before Fed George suddenly, as the biggest hawk on the cheat sheet, turned dovish. So I just had a look at the cheat sheet on Friday after Fed George's comment, and she should have actually been the heavy counterweight within the Fed for 2019 as the voting members, and she's just gone with the same mantra from JP about watching data, be patient, blah 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 blah. So reality is, I don't think, because Powell doesn't run by a sort of dictatorship like maybe Greenspan used to run it. So I don't think he has asked every Fed member to fall in line. I actually do think there is stuff out there which seems to concern the Fed, where they feel that after 9 hikes, maybe it is prudent to just kind of step aside a little bit. And I don't buy it for a minute that it has anything to do with Trump pressure. Some people are starting to argue that the Fed has become less hawkish because of Trump. That's absolute nonsense. So I agree with you that 1 month doesn't really should concern us. But if we continue to look at the data outside of the US, European data has been a lot weaker than even the ECB would have expected. China, we know, okay, 28-year low in terms of growth momentum. So the writing is on the wall that maybe the Fed has to take notice of what's going on elsewhere. What we still have is the trade war is still going. Maybe it ends in the end of January, who knows. Brexit risk is something actually the Fed has mentioned for the first time as well, which that could be from a sort of European risk off, could easily go into a global risk off on a no-deal Brexit. Now, we probably have to go past, so maybe hopefully in the next few weeks, we're going to figure out what kind of Brexit we may or may not have, which can take away some of the concerns that the world has, or the Europe has, or the Fed has as well, that start to at least soften some of the more severe shocks that were to be expected. So I think I agree with you to the point that it is not too early to say the Fed has actually just, because reality is they haven't gone dovish, they just have kind of said we paused, right? So if the data starts to surprise on the upside, then we're going to have right. Right? Yeah. So reality is what we have now is actually one thing I like, and the listeners that listen to us for a while know it has always been my view that forward guidance should not be here anymore, right? We're not in 2008. The market doesn't need to be taken by the hand and have this constant silly sort of dot plot forward guidance. So we do this, we do that. We don't need that anymore. So that means we all have the same thing, which is we watch the data, right? So, of course, the Fed has a few things that they probably have more than the market has. So maybe they have a little bit, even a better understanding that we will have if we just watch all the data. But we all so the forward guidance will now happen in the old traditional way, which is better data, the curve will shift back to a hike. Weaker data, we shift down. So the market is probably the one that has now more say again, which is probably about what the Fed wants, right? They don't want to be boxed in a corner. They don't want to pre-commit, because reality is there's a few things going on that we can't answer. We don't know whether we get a hard or a soft Brexit, or a Brexit at all. We don't know when the trade war is over, and we don't know when the government shutdown is over. I think I read that, if the shutdown lasts until end of January, that's going to knock 0.5% of GDP, right? Now, obviously, if you then talk end February, end March, that obviously then the real problems would start. But I don't reckon that, at some point this silly exercise has to be over, you would think, but you just don't know with Trump. So generally, I think the US doesn't concern me in a sense that I would worry that the US is turning down, but I don't think the US is in a position where it's going to bail out the softening in China, the softening in Europe. So you know what I mean? This sort of like what you mentioned, the surprise index. I struggle to see an acceleration in the US. So to be honest, from a US point of view, we will just take over. That means real rates are probably higher if you see that CPI has some downward pressure with the lower energy. So that should keep the dollar somewhat beat against most currencies. But I don't think we create a big dollar up move to this point. So I'm probably going to stick to those dollars where I can sell risk. So I'm still a keen seller of Aussie dollar rallies. I'm a keen dollar Canada dip buyer. And then some of the yen crosses. Obviously, what we keep discussing every week, I'm still a very big risk there. There's just no reason to go mental right now. We have a nice rally, which I like. I hope that we soon get some news from the trade war, that we actually can decide whether this is buy the rumor, sell the fact, or if it's buy the rumor and buy the fact, or what it's going to turn into. I'm still more a buy rumor, sell fact, but the market, like we discussed, I think, offline briefly or on Friday, is the market only wants to see good news. So we got this CNBC story on Friday about China is going to bail out the trade deficit from the US over the next 6 years. On the flip side, they completely ignored that the US negotiators are actually not happy with their timeline. So the negative side of things is just ignored right now. And the market just wants this bullish news. And, it just seems to run out of steam a little bit again. And as I said, I'm a risk bear. I'm not really short risk right now in a way that I would want to be. But I don't see that anything dramatic is happening right now. From the charts, which you look at the general levels, I have my ADX stuff, the directional, the momentum indicators. They all have turned in dollar yen at the yen crosses, which would tell me that right now the pressure of downside acceleration in all of the yen pairs is probably less and probably due for some 1 or 2 week range. So I'm not talking about a turnaround, but I'm talking about don't sell dips in yen pairs because we might not see a follow through. And we could probably enter in a sideways of a week or two for all these indicators to correct. Whether that brings us a higher price to get short, or if it just ranges around the levels where we right now, I don't know. I'm a bit cold when it comes to the short term. I haven't traded much short-term trading stuff, as I know what I want to do, but we never quite get there. But the pushbacks are not that I feel I missed something. So it's a very odd situation for me. I'm usually a little bit more opinionated than that, but the short term I just can't see it right now. I'll be very honest. I just don't.
Yeah, that's great. I just got dollar yen up there quickly. 110, a little bit of a cheeky level, but the mother of all levels is 112 for me.
Yeah.
Very nice, very nice.
Mine is funny enough. What is your yellow one?
That's a 200 day.
The yellow one.
200 day moving average.
Yeah. Funny enough, that's about where the mid-monthly Bollinger Band is that I looked at when I sent out the monthly charts in December. So my cheeky feeling is 111.
Yeah,
so
111.
111 is the sort of area I would probably try and get short dollar yen.
Yeah, definitely. So the other thing I want to mention on that before we move on to the next subject, which is Brexit, is I caught a podcast from Charlie McGillick, I think his name is. He's head of the vol desk at Nomura, and it was on Macro Voices. And he kind of reiterated what I've been told for a long time from MI2 partners and Julian Brigden's crew, in the sense that rates don't actually matter that much in the grand scheme of things of financial conditions. QT does. QT's the mother of all tightening. And the lumpy roll-offs that have been happening this year have just, you know, the Chicago FCI, it has an effect because it's not offshore dollars, but the Goldman's FCI has just been taking, you know, has been lifted. And this is causing increased vol. I mean, he's the head of the vol desk, so he would know. And, you know, we know as well through just looking at the charts. So that coupled with end of cycle behavior, which is completely on point with the moves we've been getting, you know, the vol complex blowout in February, equity corrections, and then big reversals over Christmas. You had the flash crash on the yen crosses not so long ago. You know, all of this, you know, he did also mention that the roll-offs are just the same as a hike. He didn't say how many basis point hikes, but, you know, so I just want to sort of throw that as well. You know, let's not just talk about hikes, you know, especially for the retail viewers we've got. Let's talk about financial conditions, which include QT and credit spreads and all of this stuff. So I just thought I'd throw that out there.
Yeah.
So I think that's brilliant, Beat, and you know, we've both got some strong views on the US macro side. Let's move on to Brexit, because we've got quite a short, punchy one today. Just as you were, really, I'm still kind of, there are so many permutations, there are so many flip-flops. I just caught a Bloomberg thing. The guys at HSBC are saying really undervalued. There's still that talk of some kind of can kicking stroke second referendum stroke delay to whatever the inevitable is at the end of March. I know the plan B is today. I haven't heard any news on it. But
to be honest, she just spoke in the last hour, and you know, sterling ticked up a little bit, but there's just not that much in it. It seems like she tries to pretend that she is listening to what people say to her in all these cross-party talks, and she said she will go to Brussels with all, you know, that cross-party talk to sort of inform the EU about what's been discussed, so more or less tell them, you know, this is what we need, blah 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 blah. I mean, I think we outline all the possible options, from no Brexit, hard Brexit, delay of Article 50, second referendum, general election. You know, and I've written a piece last week where from the 6 reasons, 4 were obviously more on the bullish side of sterling, 2 on the bearish side, and obviously if we try to rule out general election, then we only left with 4 good ones, 1 bad one. So I have sympathy when the market is trying to buy sterling, just point blank ruling out no deal Brexit. The only thing I would say there is on referendum day, people bought cable at 150 because they're absolutely convinced that the result is going to be remain, right? So we know how. So the reason I'm still not very involved in sterling is just, yes, I see that the odds are maybe that it's less of a risk of no deal Brexit. Having said that, since we rejected the deal in Parliament, we are actually at no deal Brexit. The only deal that we had, we rejected. So that's just a fact.
Can you tell the market that?
Yeah. So reality is that I do not disagree that if everything would turn out to be okay, that sterling is probably undervalued without a shadow of a doubt. Like what we discussed last time, we're going to have a lot of underweight asset managers pension funds, so on, so forth, that probably once we take away the no deal Brexit risk, are probably more willing again to go back to benchmark in terms of UK assets. Then that in itself would probably already create some demand in sterling. Now, we probably have different topics on how high sterling should go. So by a pure delay of Article 50 without much else on the agenda, yes, sterling will probably have a relief rally a little bit higher, 131, 132, but should it really go a lot higher? Because Article 50 is just a famous kick the can down the road exercise, unless we kick it down the road because we either have a second referendum or we have general election, whatever else. But if you just kick it for the sake because we just can't get the act together now, that means we could have the same problem in 3 months' time. So the negative side for us in the market would be we cannot remove the uncertainty for good. Yes, we're going to have a relief rally. Yes, everything looks short-term a little bit better. And then at some point in a month or month and a half time, we start to worry again that we end up at the same situation we were last week or when we had the vote to Parliament. So, you know, I just thought it just seems you have Corbyn that doesn't want to talk to May as long as she doesn't remove the no-deal Brexit risk. I understand from her point of view that she doesn't remove it, because if you remove that threat, the EU has absolutely no incentive to give any little, you know, help if they know, okay, Britain anyway doesn't want to do the no-deal Brexit, so we give them nothing. So maybe they get so fed up that they don't exit after all, right? Because that is still what I consider to be the hope of the EU, right or wrong, that Brexit will never happen. Maybe it does never happen, I don't know. There are people, some famous fund managers, who started buying sterling apparently in the last few weeks on the view that Brexit will never happen. It's a very ballsy. That's why we both said, if you have deep pocket, maybe you can have such a view. But if there's suddenly a range of uncertainty coming in, whether hard or no deal Brexit is actually a risk, suddenly we're back to 126, 125. That's a mere 400 points lower than we are now. So I just can't, and I'm not willing to bet on a 50-50 that can move the market 3-4% against me. That's just the simple, you know, answer that I have to this. So from what I've seen, what May was saying this afternoon, I don't think we're any further. I don't think she has really clearly. It almost looks like she gathered all the feedback, goes to Brussels and says, that's what we don't like, blah, 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 blah. And then may see whether the EU offers something that she can bring her deal back, slightly changed. She has not taken her deal off the table yet, which means she want to bring it back, maybe in a slightly different form. There's the other conspiracy that says the Brexiteers are so worried that we don't exit that they actually could support the deal that is currently on the table, just that we have a Brexit. So, you know, just us talking already tells you, you know, no one really has a clue.
Yeah.
They don't have a clue, so how can we have a clue? That's
exactly.
Really it.
Exactly.
Right.
I mean, I guess we always talk about each week, and I think it's really important, just with the hope that, you know, often, certainly you do this with your commentaries, you're talking out loud, and sometimes something will galvanize, and you go, oh right, you know, you'll flesh something out, and obviously with Brexit it's very, very difficult. I guess in my mind, and this is only personal, and I might be wrong, but this is how I feel. In my mind, a lot of people voted to leave, and now they regret it. And what these people are thinking is, the longer we delay it, the more chance it might go away.
No.
And you know, if there's a delay, maybe, you know, that just brings us closer to a second ref. But you know,
it's like what you highlighted. Our job in a situation where we just don't have the answers, we just have to play through every avenue of possible outcome and have a view to it, what it means for the market. So when the news actually hits, and that's just how I work. So I have like 7 scenarios ready, sort of 7 sort of what happens to sterling, or high or high low it would go. And so that means at least you're prepared. Whether this is all right, has to be seen. But at least once the news hits, you kind of can put it in one of the sort of 7, points we were discussing. That's the only thing we can do.
Exactly.
Cover every eventuality, and then hopefully if one of the 7 or 8 or 5 come out, we kind of know what we probably can expect. The answer, we don't know. We can't give the answer, and I wouldn't even lean out of the window to give it. Gun to my head, I would actually say that probably there has to be some solution, but because I was so wrong in the referendum, I was in the M25 bubble, that I actually don't trust myself to say this, so I say nothing.
Yeah, exactly. I totally agree. But now that I've rewatched Dad's Army, and it ain't half one quite a few times, not sure I agree. Stumbling is a very real possibility.
Yeah.
That's fantastic. I'm going to wrap on the Brexit. Now on to risk. Just kind of, you touched on it in the start of the webinar. Thanks, Beat. But for me, I was short on some yen crosses a week and a half ago, I think, and I just cut it. And we're much higher. Yen pairs have been lifted since then. Just a personal thing, I'm quite impatient, and that comes down from my futures and day trading. That was drummed into me. But it's not to say I'm right or wrong or whatever, because the market could have done the other, but that's just me. I feel that and we spoke about this offline, I feel that until something breaks in China, there's going to be a continual grind up on risk pairs. Could be a really long, dirty squeeze, quite painful and slow. One of those ones, I feel. So the market, as we mentioned, the market wants a risk on. I just feel it could be short-lived, or maybe it's holding out some hope. I sent you an email, Beat, about a kind of, not really trading, but just a bit of common sense in that we're talking about the ratio of imbalance on the trade, and I think in 2017 it was 5-to-1, something like that. 530 billion to 1.23 billion for the US and China. It doesn't get away from the fact that the cost of living in China is much, much lower than the US, and cheap electronics. That it's like I go to Tottenham Court Road or wherever, and I see a MacBook, or I can see something else for half the price, and it makes me question what I want, and I'd love to be, if I was an American, I'd love to be putting America first, buying American products, and all the rest of it. But if I'm on just slightly above minimum wage, and I've got mouths to feed, I want a good, and my children want an electronic device, then
to be honest, Trump's idea, if we just, I know we probably don't have enough time to go into the detail, but reality is what he's doing, it's turning back the clock a little bit of globalization. Like people, and the US is not the only country to have realized the downside of globalization. The advantage is, as you just said, you can buy everything for half price from somewhere else, and that is what has led to the deflationary tendencies of the last 10-20 years, or definitely the last 10 years. And it's probably the answer why inflation has never really picked up the way we feared it will. Now the end game would be buy America first. Okay, you bring the job back, everything gets a little bit more expensive. That gets carried by higher salaries because more jobs are in the US. So it could work, but the transmission to that is a very complicated process. And So I don't believe that this is going to work. But I think what Trump is doing, and I'm not, want to hold a speech to support Trump in that way. But what we often said is, if you forget his persona and the way he delivers stuff, you just dig down to the core what he's talking about or what he tries to achieve. It is not wrong that now finally the world has woken up to the fact how China is practicing, what China is doing, whether it's this theft of intellectual property, Huawei, just as a reminder. Even Europe woke up to the fact that they start to look at them and try to ban them for the new G5 networks. So there's a story to that. And that is maybe the reason why I don't believe you're going to get a full-out trade settlement between the US and China. We're going to get agreements on some stuff, car tariffs here and a bit of soya beans there, and like some key elements. But I think there's a fundamental difference, which has to do with the way China has grown in the last 20 years. There's just a complete different view from a down-to-earth kind of society point of view, which I think they're just on two different levels, which they will never agree. So, that is where I see this trade war heading, where we're going to solve half the problems, we keep half the problems. But where I agree with you is what Trump will probably be unable to achieve is, tell Apple close all the foreign production sites and set it up at home. So how expensive is the iPhone going to be? Double, right?
Yeah.
So, so there is probably a middle way somewhere. But no, I sort of agree with you that this whole story is I think Trump made his point. I think China understands that they may not get away with everything anymore, and I think the ball is actually in China's court to decide how far they're going to be to play international economics by standards that we consider as standards in the Western world or developed world, or if they don't want to play that way. And if they're in for the long haul, which I believe China is, then they actually might have to just change. But I don't know. It's a very difficult topic anyway. But I think I'm sure we can cover that once in a more detailed.
Yeah, we'll do that next week. That's fantastic, Beat. Really, really good. I'm going to. I've just realised I'm actually almost pitch black now. So without wanting to look even more weird and mysterious, I think we're going to probably have to wrap. So you've got a very special announcement, and we talk about it every week. It's something you provide. You put a ton of work into it. It helps me, and your clients are institutional. There's a few. I think you've got a few retail, but it's very valued by both retail and institutional space. And you've got a very special announcement. So do you want to let us know what that is?
Yeah, to be honest, rather than actually just highlight what I do every week when we talk about, I would just say the following, that those of you that are watching our session, I prepared to offer a 1-week free trial to everyone who has an interest. So you can email me on beatnussbaumer@outlook.com to I put you on the list for a week, see what I'm doing, and then decide whether or not you have any interest, or ping me on LinkedIn or let Patrick know. And I'm happy to put everyone who has an interest on a 1-week free trial. You see the work. It's probably easier to see firsthand than us just talking about it. Then you can make your mind up whether it adds any value to your trading or your understanding of the way we sort of talk about stuff. So that was a big announcement. Back to you, Patrick.
Fantastic, mate. I will put your email on my feed if that's okay.
Yeah, that's fine.
Obviously, you can direct message Beat. That would be best, or myself if you are not connected with him or whatever. But his email, I'll post that on the Making Sense of Macro along with the link. So perfect. You just send him your email and get hooked up. Got nothing to lose. It's a week. It's absolute mustard. So, you know, thank you very much, Beat. That's a
Thanks,
brilliant
Patrick.
offer. And until then, before I don't turn out the lights completely, I wish you a good day. Watch that
Yeah.
wrist, and thanks a lot.
Thanks a lot, Patrick, for having me. Good
Thank
one.
you.
See you.